Now, before we look at crude oil on the water, we wanted to touch on what happened with China in February. So here you can see that there was a big dip in imports for China, but it's important to put that in context because, as you can see, there's normally a dip in February, and that's because of Lunar New Year. Now you had some extra pressure because of the Olympics, because of some of the start of spread of COVID. So realistically, and also you can't ignore, you had pricing. So now you're starting to get some of this normalcy back. Now you have China that's like, well, I can start playing a bit aggressive depending on the discounts I can get from Russia. So we do expect this to bounce and have a normal seasonal bounce, as you can see it, that we normally bounce in March. It's just, we don't think we're going to go back to 2021 levels. It's just, we're going to go closer to where we were in 2020, which I think is going to be, or something in between, but closer to the 2020 line, as China looks to kind of take advantage of some of these different pieces. Now, when you start looking at the different shifts, after years of uncertainty, Qatari LNG sales, you have Germany now looking to buy, doing a deal with Qatar. We'll talk more about that in the Econ show. But again, Europe is trying to figure out how do we kind of get away from some of this Russian natural gas. So you're going to start to see shifts outside of just oil, but also on the natural gas front. Saudi Arabia is now China's top crude supplier in the first 2 months of 2022. And that's because Russia, the shipments have dropped by 9%. And the cut in import quotas obviously was a big piece of that, especially when you start looking at ESPO and SOCOL. But as some of those prices come down, we do expect that to get a bit more competitive. Saudi crude totaled 14.61 million tons in January, February, or about 1.8 million barrels per day, down from 1.86, but again, still elevated and still seeing some of those flows. Now, crude oil on the water is back to a seasonally adjusted all-time high. You can obviously see 2020. We're still seeing this climb up, and it's just because there's more crude in floating storage, and there's just more stuff floating around as you get some of this competition of, can you sell Russian crude? How much Russian crude is sitting in floating storage, or just kind of bouncing back and forth trying to find a home. And this is something that we believe is going to remain very much above normal when you look at crude oil on the water. Crude oil in transit moving back up. It's slightly above where we were in 2020. We expect this to remain very elevated and moving in the upward trajectory as you have some of the competition with crude from West Africa starting to move, crude from Russia starting to move again, and then the Middle East starting to get a bit more active in trying to, because you have to remember, Oman, Dubai is still almost $11 cheap. Now it's over $11 cheaper than dated Brent. So even though dated, Urals are selling $31 below dated Brent, you still have an impetus to go towards the Oman-Dubai spread and trying to buy some of that Middle Eastern crude, which is why we talk and look so much at what is happening with Middle East flows. Crude and floating storage right at where we were in 2021. We do expect this to shift back up, and it's just going to be a matter of when does that oil go from floating storage, go from transit back into floating storage. We will see some of those pivots, which again is going to continue to come through overall. So this is the one that's going to be to watch. It's that timing delay. It'll go sideways and then really start to ramp up as we go, as these boats start to show up on the shore. U.S. crude exports, gasoline had that outsized increase of 278,000 barrels a day. That's 434,000 above the 5-year average. There's still excess amount of gasoline in PADD 3. They're going to try to get that out just because you have to prepare for summer driving. You have to get summer grades ready. Going to try to get some of the winter grade into the market out of the PADD 3. PADD 3 is still long gasoline. PADD 1 is short. Because of the Jones Act, it's a bit difficult to get that. And then obviously you have summer blends that you're competing with that you're going to have to start using. Disti had a drop of 484,000 barrels a day. We expect this to remain a little bit elevated, not so much, I would say back to the 5-year average, just because there is money to be made, especially in the export market, with some of that kind of reversing. And typically PADD 3 sends diesel from Houston into Europe. That is going to start to open back up because the spreads are wide open going from the U.S. into the European theater. Now, when you look at jet, again, something small, but propane had a drop of 160,000 barrels a day, still 170,000 above the 5-year average, will remain strong. And then when you look at crude had another sizable increase of 908,000 barrels a day. That's 3.844 million above the 5-year average. Above where we were. We were saying that we were going to be at about 3 million. Here we had a big shift to about 3.8. We expected to come down to about 3.2 based on what we're seeing on the water. Now, when you start looking at gasoline here, you can see that nice big spike. We do expect this to come down a bit just because of seasonality, but still remain above the 5-year average. Just remain, in the top, at the top end of that cloud. Here you can see diesel had that sizable increase, now decline. As we were saying, back below the 5-year average. We do think that there is now more support to keep us closer to the 5-year average flow. Ethane, very lumpy, came back in. It's going to go back up again. Not much to change. Some of the exports could slow just because of Chinese lockdowns, because some of those areas are big on the petrochemical side, steel, aluminum, as well as refining. So that could weigh it a bit. But again, there's also a shipping delay to go back between. So because of that, we do expect to see some of these flows remaining elevated. So now when we start looking at crude oil exports, again, still staying strong, but it's, I think, more important to look at the 4-week rolling average. We are now above 3.2 million barrels on the 4-week rolling average. We expect this to stay, again, between that 3 million and now probably 3 to 3.2. As we said last week, there was a sizable bid that came through that's going to move things into Europe. That should come back down a bit, but again, still staying at an elevated over 3 million barrels. Propane dipping down into the top of the cloud. Again, it's just going to be above the 5-year average, whether it's a seasonally adjusted all-time high or at the top end, it's still going to remain very strong. When you look at the swap, here's where we were talking about with just what is happening between dated Brent and Dubai. We're well over $11 in terms of the spread. That's going to keep things moving from the Middle East and put a bit more pressure on what is going to be sold using the dated Brent as a benchmark. But, especially when you look at West African crudes do have a high distillate cut. So we do think that that's going to put a bit of a bid into them and help things move about, especially when you look at refining margins. So obviously crude prices have gone up, but we've also had LNG prices soar. Natural gas, Henry Hub is over $5.20 now. So this is not really looking at some of that. So that kind of mutes what we're seeing. But again, margins are still there. Going to see Singapore and some of these areas remain elevated, especially on the hydrocracking side. Again, distillate is just short, especially when you look at Singapore flows, when you look at Singapore storage, one of the shortest markets we've been in. Going to keep that hydrocracking elevated as things continue to move, as they're trying to fill that void. Now, when we look at flows, as we've said before, and as we've been talking on Twitter, we've had some cancellations in what is being sent into the market from Russia. Russia has now canceled about 2 million barrels of exports. And that's due to the inability to get ships. Again, day rates, insurance become a problem when you start looking at the Black Sea, putting a bit of pressure on Urals. But we're still seeing slowdowns in Nigeria and Angola, not seeing a whole lot clear, still seeing some of those pressure points, which we don't see adjusting anytime soon. So again, things flowing through in general. When you start looking at Russia, remember 4 million barrels a day was supposed to go through in March. We do expect that to come down a bit. Thailand bought some of the Abu Dhabi, loading at a premium of $7.50 to the Dubai benchmark. So that's why when you start looking at Thailand, Vietnam, Malaysia, Indonesia, there's going to be some of this pressure on when do we start to see rates go back up? When do we start to see some of those pressure points? Pakistan is risking a $6 billion bailout program from the IMF because they're reducing fuel prices and promising to not increase them till at least June. The Philippines, the government is resisting a relief on excise tax, fearing the impact it will have on revenue. So again, you're starting to see these pressure points. India is taking advantage of some of the Ural discounts. They bought almost 5 million barrels combined of Russia Urals crude, and Nigeria grades via tender. Vital sold 3 million barrels of Urals, while ExxonMobil sold 975,000 of Agbami, which is Nigerian, and 1 million of Usan. Two tenders. And again, when you look at March Urals, you're seeing things on a CFD nudge down to $28.46 below dated Brent. But then when you start looking at things on a CIF level, you're starting to see things at minus $3.35. So again, a lot of discounts coming down into the market in general from that perspective. Now, when we start looking at crude, Europe had a bit of a build. We're now back above where we were versus 2020. We do expect this to continue to move back up as we do have refineries in some turnaround season, and they're trying to wave in as much crude as they can ahead of some of these refiners coming back. Here's where we're starting to see gasoline. Gasoline had a big build of 208. We're now back over 1.355 million. Again, that's something that we're going to see some of that continue to move out, but gas oil remains tight. Here, the only time we were lower was in, I believe it was 2008. So again, you're seeing things that are very difficult right now in general. And we don't see it getting any better, which is why we're going to see some of those flows coming into Europe. Fuel oil still remains high. We do expect some of that to go either get recracked or go from west into east, and you're going to see a displacement of, instead of using gas oil and very low sulfur fuel oil, you'll start to see more high sulfur and just straight fuel oil. Here's that big increase in gasoline. The only time we were higher in Europe was in 2021, and we all know what happened in 2021. Given where we came from 2020, as you can see, we're right where we were in 2020 when you look at the back end of the year. This is where we're seeing again that decline where we're seeing those declines when you're starting to look at demand destruction. It's really on the European side. Now, some of the things that we just saw, India bought another 3 million barrels of Urals from Vital. Right now, it looks like it's going to be something closer to what we've seen in general. So India and China continue to step in and buy those crudes. Now, when we start looking at fuel oil, here you can see just where we are on the fuel oil side. Still elevated versus the historics. They're going to try to balance this, and we should see some of this either get recracked or sold back into the Eastern world. Light distillate in Singapore had a build of 300,000. Middle disti, another drop. Again, that's the issue that we continue to see. Total stocks went from 44.7 to 44.9. So pretty much right in line with the average. We see this staying, trending actually above the average as more gasoline and light distillate builds continue. And here's what we're seeing, kind of this pivot up. We expect this to continue to climb higher and go above, again, that high point from the end of Feb. We do expect this to continue to climb higher. Again, it won't be in a straight line. We'll see some of this waffle back and forth, but the trend will be up on the light distillate side. Middle distillate trending down, setting new all-time lows going back to 2007. If we go out to the full amount, there's lower, but I think this is the kind of the most relevant side, and this is keeping those prices elevated and those refiners active. On the resid side, continuing to trend up. This is something that will continue to trend higher and start to flatline, and that's when you're going to start to get, and that flatline is when you're going to see the bigger increase and swap from middle distillate to heavy and resid as they're looking to just cover, just trying to take advantage of that pricing. As we were saying last week, we had a small increase in Fujairah. That's something that we think will continue. The total stocks, we had a small drop of 342,000, but what we've seen come through, we're seeing a bit of those increases again on the light disty side. Light distillate increased 237,000 barrels. That's something that we continue to see a bit increasing a bit. East of Suez gasoline market had some support from a combination of refinery outages coupled with an increase of seasonal demand with Ramadan. So it's important to look at Ramadan because you try to get things in ahead of time. So that's why as Ramadan comes, things will slow down a bit and you're going to start to see some of that demand wane, which again is going to increase demand, increase those storage of light disty. Middle distillate increased 86,000 barrels, still very, very tight. Gas oil market was finding support with steady demand coupled with low stocks, leading to the market structure. Demand is good. People are now looking for spot barrels as the geopolitical issues continue to arise. Then when you look at heavy resid, it fell by 665,000 barrels. That's starting to reverse a bit. Again, it's just because it's very volatile, coupled with flat pricing. So that's where, light distillate grinding higher a bit, middle distillate, heavy to resid moving up a bit, which again is going to keep us elevated. The time spread between May and June exploded higher again, almost at $4. That's something that, again, we just see this being a very volatile move, especially when you start seeing some of these discounts. What are some of the things coming through as Shell is now bidding more diesel into Europe? China's super tankers remaining fairly flat. You can see seasonally adjusted, very normal, especially when you look at it against 2019 to 2021 levels. We expect it to remain fairly stable as they look to pull in more capacity. But as the delays onshore continue with more lockdowns, that's going to put more offshore. So we do expect Asian floating storage to move higher. It's just going to be, as we keep saying, a kind of that timing delay as to when. And then when we start looking at North Sea, it's going to remain flat to either zero or just slight increases because Europe's going to keep waving it in to help replenish the Ural shortage. West Africa, another big increase in floating storage. You can see that it's well above where we've been really any time ever. This is, again, this is going to continue just because the Urals also puts out a decent distillate cut, as well as ESPO and SOCOL. So if China, India, and Asia can go buy Russian crudes at a steep discount, that'll leave more West Africa crude in the market, which they're going to have to increase discounts in order to move it into Europe and the US. So you're just kind of seeing a shift as to where it's going, but still a lot of West African crude available. So we're still not seeing a whole lot of panic on the physical market side, because if we were, there'd be bids out there for anything and everything flowing, and West Africa would be one of them, especially for Europe and the US. Middle East as well. This should be lower just given where the shift is. Now, we did have the spread between dated Brent and Oman Dubai go from a $20 spread or over $20 spread to an $8 spread. So that could have slowed things down. Now as it's opening up to about $12 a discount of Oman Dubai versus dated Brent, this could help move things through. But again, you're also seeing some of the slowdowns just because we do have refinery maintenance. We do have the Middle East increasing some production along the OPEC agreement. So that'll be something to watch. As Europe stays low, will remain low, will be the problem going forward. Now you can see here that China Shandong or the teapots have had a steep decline in operations and run rates, and a lot of this is due to just the inability to get crude from the water onshore and getting personnel on top of just a broad slowdown in demand caused by COVID, which again is going to keep China fairly capped in terms of what their demand is going to look like in the near term, or at least I should say until the middle to end of April. So that's what we have for you today. We won't have our EIA show next week. I will be in Texas for work. I will be speaking at an event on Thursday. So hopefully you can survive another a week without me. So I'll try to be as active as I can on Twitter, try to put out some of the updates that we normally do, and keep it brief. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.